It's the start of a new year, and like many other YouTubers, it's my one chance where I get to pick my top stocks going into 2026. But this year, I've got to admit, I feel a little more added pressure because of this video right over here from Adriconomics, where he compared several different YouTubers' picks for all of 2025. It happens to be a great video if you haven't already seen it. And to make a long story short, at the end of the year, I wound up taking the top spot. First off, I absolutely love his video concept. And second, I'm pretty impressed that most of these YouTubers wound up beating the S&P 500. Hi everyone, if you're new to the channel, I'm Brian, and I happened to retire 6 years ago at the age of 46, which is only after a 15-year career at companies like Target and Amazon. And if you happen to do the math, then yes, I started my career at 31 because I happened to serve in the Air Force right before I went to college. So my whole point in sharing that is that if you think that you're starting late in life, look, I was 31 when I started to invest, and it only took me 15 years to retire. So the whole point is, it is never too late to start. Now, I am not going to waste a lot of time with a long setup for this video because if you've seen any of my other videos, then you know that I have a technology and growth stack focus that happens to be across AI, robotics, data center infrastructure, quantum computing, and power generation. And those areas are still going to be a focus for me this year. And hey, as just a quick reminder that I am not a financial advisor, and this is only for educational purposes. As always, please do your own research. Now, my intent with these stock picks is to let the data tell the story and why these companies align so well with my investment framework. Let's begin with Arista Networks, the company that builds the high-speed networking fabric inside cloud and AI data centers. GPUs may grab the spotlight, but Arista sells the switches and the software that allow those clusters to function at scale. The long-term trend for them is clean. Revenue expanded from $2.3 billion in 2020 to an estimated $8.5 billion in 2025, nearly a 4 times increase in 5 years, or roughly a 30% CAGR. What stands out to me is that profitability is scaling faster than the sales. Net margins expanded from 27% to over 42%, meaning earnings compounded far faster than the revenue as the business gained its operating leverage. And of course, that momentum carried over into 2025, where revenue growth stepped from the mid-teens in early 2024 to the high 20% range, with quarterly revenue reaching $2.31 billion and net income up 37% year over year. In this case, the pattern matters a little bit more than just a single quarter, because the growth accelerated rather than faded as hyperscaler spending continued over time. And the cash flow is where Arista separates from most infrastructure names. Free cash flow margins exceeded 50%, supported by CapEx at well under 1% of revenue, generating more than $10 billion in cumulative free cash flow from 2023 all through 2025. That cash built a fortress balance sheet. Arista now holds roughly $9.5 billion in cash and investments against about $60 million in debt, giving the company flexibility without relying on external capital as the cycle begins to evolve. What ties all of this together is their positioning. As AI clusters begin to scale more and more each year, networking becomes the overall bottleneck, not compute. And Arista is already embedded at that layer. The company is monetizing hyperscaler refresh cycles with high 20% revenue growth, 40% plus net margins, and 50% plus free cash flow margins all at the same time. That's a combination that's nearly impossible to replicate in infrastructure. The single metric for me that matters most is revenue growth. As long as it holds in the mid 20% range, hyperscaler spending remains intact. Analysts give Arista Networks 36% upside over the next 12 months. Next is Applied Digital, a company building large-scale AI data centers designed around 2 constraints hyperscalers care about the most: compute density and power cost. The entire model is built on securing long-duration, low-cost electricity and locking them into long-term leases before the capacity shortages begin to force prices higher. The growth curve for them is extreme, where their revenue expanded from $8.5 million in fiscal 2022 to $215 million in fiscal 25, with the most recent run rate of around $257 million, and that represents a 194% CAGR over 4 years. That's nearly 7 times faster than the broader AI data center market, which is growing at around 28% annually, translating into a 30 times revenue increase driven by infrastructure that already exists or is under construction. Now, what separates Applied Digital from other data centers is where their revenue is anchored. The company deliberately builds in power-rich regions like North Dakota, where electricity is extremely cheap and it's abundant. Locking in low-cost kilowatt hours upfront allows Applied Digital to offer hyperscalers long-term pricing certainty while protecting its own margins over 10 to 15-year leases. In this market right now, the cost per kilowatt hour matters a little bit more than the headline capacity. Now, to me, for them, the timing happens to be the catalyst. For fiscal 2025, the revenue grew 58% year over year without the first major AI facility fully live. The Ellendale campus came online in Q4 of last year, adding roughly $50 million per quarter initially, and it's going to step up materially higher as additional buildings ramp up through 2026 and 2027. For me, margins explain why earning power is being underestimated. Gross margins compress down into the lower teens during peak construction. And that's just build-out costs. That's not even pricing pressure. Once facilities are fully leased, the model is targeting gross margins of 45% or higher, and that's consistent with mature data center REITs. For me, the single metric that matters the most for them is the megawatts that get placed into service. So for roughly every 100 megawatt that goes live, that's going to add roughly $200 million in annualized revenue, and it's going to be at incremental margins. With capacity funded and contracted, execution, not demand, is really going to drive their outcome. Analysts give Applied Digital 37% upside over the next 12 months. All of the companies that are associated with artificial intelligence, nuclear power, and infrastructure, they all rely on precious metals. And that brings us today's sponsor of Vanguard Mining, which owns gold, copper, lithium, uranium, molybdenum, which I'm going to refer to as moly, and palladium. There are very few companies that offer more than just one critical mineral, but Vanguard Mining owns a diversified portfolio of 6 key materials, and it shows in their most recent 1-month return up over 20%. They hold direct ownership of projects in safe, US-friendly jurisdictions, including Canada, Argentina, and Paraguay. Their assets include the Brussels Creek Gold Copper Palladium project in the Redonda Copper Moly project in British Columbia. In Argentina, they hold the Pocahontas 1 lithium salar, which is a significant asset as lithium prices have already doubled from their 2025 lows. Vanguard also controls over 90,000 hectares in Paraguay's Parana Basin, situated directly next to the world-class uranium trends. These resources are essential, as China currently processes 70% of the global lithium and produces 45% of refined copper, all while their recent export controls cause moly shipments to the West to collapse by over 95%. Now, moly is critical for hardening and strengthening of all other metals. By securing these supplies, Vanguard is providing the materials necessary for the 24/7 carbon-free power requirements from these big tech data centers and national infrastructure. So if you'd like to learn more about Vanguard Mining, please check out the links down in the description. Next is AeroVironment, a company that has moved from a niche drone supplier into a broader defense technology platform. The growth does look a little bit dramatic at first glance, but the real story is how that growth was created and what has to work next. For most of fiscal 2025, quarterly revenue ran around $170 to $190 million, and then it stepped up to $275 million and quickly moved above $450 million per quarter. That massive jump was not organic. It was from a $4.1 billion Blue Halo acquisition, which did happen to triple their revenue, and it added lasers, space system, and counter UAS. And that same acquisition explains what you're seeing in their margins. Gross margins fell from the low 40% range down into the high teens, and that's driven by a heavier service mix and a sharp increase in amortization. The revenue had changed overnight in a good way, but the profitability didn't. The market already accepts the revenue reset. The focus now is squarely going to be on integration. Now, for me, what I think is going to support the long-term case is their scale. Their most important product, their Switchblade, their production had increased roughly 6-fold in about a year, and capacity is being built to support thousands of units annually. These systems are combat proven, and they're already deployed at scale, which separates AVAV from their competitors, which are still validating designs rather than delivering volume. And something that I love is that backlog adds durability to their scale. Funded backlog grew from roughly $400 million to more than $750 million, with total bookings now exceeding $1 billion. Long-dated Army and Air Force contracts extend revenue visibility into the next decade, and they move AVAV a little bit closer to platform-style defense supplier rather than episodic hardware sales. Now, what I think is going to drive the next phase is the stack around drones. Drones happen to remain their bread and butter. Lasers address the rising cost of defending against mass drone threats. And cyber and space lengthen contracts and embed AVAV into multi-year programs. That's a pretty good balance of volume, relevance, and durability, all in one platform. To me, the single most important metric is their gross margins. The collapse into the high teens reflects acquisition accounting. It's not a mix problem, and it's not a demand problem. And the recovery to get them back into that mid 20% range is really that hinge on their earnings as the integration begins to progress. Analysts give AeroVironment a big whopping 1% upside over the next 12 months. Now, this one is a good one to wait for on the dip. For me, it kind of stinks because it went up about 40% in the past 2 weeks while I was in the process of putting this video together, and I'm really glad that it was already in my portfolio going into the year. Our next company is IonQ. Now, most quantum companies are still trying to prove the technology, or they're trying to force a business model on top of it. IonQ is pushing both forward at the same time, and that's finally starting to show up in their real results. Quarterly revenue jumped from the low teens millions to nearly 40 million in Q3 of 2025. Almost all of 2024 revenue in a single quarter. That one single step change shifted IonQ from a research story to an operating business. And I think that margins really explain their approach, because gross margins have sat below 10% by design. IonQ has been willing to sell systems at near cost to get embedded early with governments and enterprises. And I think that they're banking that the payoff comes later, as access, usage, and services begin to matter more than the hardware itself. Where IonQ stands out from the rest is its fidelity. 2-qubit gate fidelity at 99.99% means error correction becomes practical. Fewer physical qubits are needed to do useful work. IonQ wins on reliability, which shortens the path to real workloads. The stock already reacted to that progress once, running from about $8 to the mid-$80 in 2025, and then pulling back roughly 40% and settling at around $50. That looks like consolidation after a major repricing. To me, it's not a broken story at all. Now, what ties this together for them is the shift from selling a system to becoming the system. IonQ is using early contracts to get embedded, and its technical lead gives customers a reason to stay embedded as workloads begin to grow. For IonQ, the single metric that matters the most to me is their revenue trajectory. Continued step-ups confirm IonQ is turning quantum into a real platform business. Analysts give IonQ 49% upside over the next 12 months. That now brings us to our favorite AI company of NVIDIA, which isn't just a chip supplier anymore, because it's the platform that's underneath all of modern compute. Data center revenue hit $51 billion in Q3 of fiscal 26, and that is up 66% year over year, and it's now making up 90% of their total revenue, where that scale funds everything else that NVIDIA is building, leading to the Vera platform, which delivers 5 times inference performance, 3.5 times training, and it runs tokens at 1/10 the cost. Lower token cost means everything in the world of AI, and expands how much AI can be deployed at scale. These gains come at the system level. It's compute, networking, memory, and software designed all together to work together. That's why customers buy entire racks, not just chips. And their demand just keeps building because compute now scales 3 different ways. It's training, it's post-training, and it's inference. That combination is what sustains infrastructure demand even as individual models begin to mature. And of course, software adds another layer on top of all of that. NVIDIA AI Enterprise is running at a $2 billion plus annual pace, growing triple digits, recurring revenue that compounds as the installed base also continues to grow. To me, their runway ahead, it still remains so large and so far out there. Most global computing infrastructure still hasn't even transitioned to accelerated compute, which leaves years of modernization ahead for companies like NVIDIA. The single metric that matters most to me about NVIDIA is their data center revenue growth. As long as that remains strong, then it confirms to the world that NVIDIA's role is at the very center of this compute transition. And even today, analysts are showing NVIDIA a lot of love with 44% upside over the next 12 months. Our next company is Lam Research, one of the core companies sitting behind every advanced chip build. Now, Lam doesn't just design chips. It supplies the etch and the deposition tools that make advanced logic and memory possible at scale. Looking at a wide range, their revenue grew from $1.6 billion in fiscal 2006 to $18.4 billion in fiscal 2025. That is an 11 times increase, which is also roughly double the broader semiconductor market's growth rate at the same time. That happens to be structural share gain. It's not just cycle exposure. And then gross margins stayed flat, but operating margins expanded from the mid-20s to 32%, and net margins hit 29%. That's the definition of operating leverage. Fixed costs like R&D don't rise as fast as revenue, so profits begin to scale faster than the sales. The cycle profile has improved too. Drawdowns moved from negative 56% during the GFC to roughly negative 15% in the most recent normalization. Lam captures the upside without giving it all back in the downturns. For me, the current driver for them is high bandwidth memory, or HBM. Each stack requires 2 to 3 times more etch steps per wafer, directly increasing Lam's content per chip. With HBM production growing at 50% or more annually through the next 2 years, this is a new demand vector, and it's not like the normal memory trajectory that you would see where it would boom and bust every other year. Lam generated $5.7 billion of free cash flow in fiscal 2025 at a 31% free cash flow margin, returning 80% to shareholders through buybacks and dividends. And as chips get more complex, manufacturing steps rise, and Lam's tools sit directly in that path. AI and HBM make manufacturing a heck of a lot harder, which only increases Lam's relevance over time. Now, in this scenario, the single metric that matters the most is operating margin. As long as margins expand faster than the revenue during recoveries, it confirms Lam's operating leverage is still intact. This is one that I will keep on the ready to buy whenever there's a future dip. Now, this next company is Amazon, which many of you know is my former employer. And for this one, the only way to really understand this stock is to zoom out, and I mean zoom way out. Amazon has never moved smoothly. It surges ahead of the market, and then it spends years going sideways while the business begins to catch up. From 2010 to 2014, it absolutely exploded, and then of course, it stalled. From 2015 to 2018, it broke out again. And then, of course, it went flat again. After the 2020 surge, the stock for the most part has been sideways. I mean, to summarize it, they tend to outperform in microbursts, and then they'll underperform or just pause for long periods. That's always been their pattern. And strangely, the breakout never really comes at peak excitement. It just comes after a lot of boredom. Since 2023, Amazon is up 15 to 20%, while the S&P 500 is up 45 to 50%. 2 years of underperformance right on pattern. Now, AWS growth is accelerating back towards 20%. And historically, Amazon doesn't leave holding patterns until AWS turns first. Operating income surged from $12 billion in 2022 to $69 billion in 2024. That's 5 times growth in just 2 years. Free cash flow swung from negative to $30 billion plus. This isn't just cost cutting, it's operating leverage showing up at scale. And yes, data center spending is rising again, but unlike past cycles, this build out is being funded by profits, not just balance sheet stress. Thankfully, Amazon is starting to invest from their strength. And today, the setup mirrors prior breakouts. The stock compressed near highs, momentum is constructive but not overheated, and volume is starting to expand. So it's the same backdrop that we see today. In my mind, Amazon has done the hard part. Margins rebuilt, cash flow restored, AWS is reignited. The stock spent years consolidating. Historically, that is the setup. It's not the aftermath. of the next move. Now, for them, the metric that matters the most to me is returns as data center capacity begins to fill. If they happen to hold, then Amazon exits another pause, and history says it won't stay quiet very long. Analysts give Amazon 24% upside over the next 12 months. This now brings us to advanced micro devices, or AMD. And the right way to frame AMD right now is that the stock is being priced like growth is slowing down, while the data, obviously, is saying the opposite. AMD grew revenue from $10 billion in 2020 to $34 billion in 2025. So that's 3 times within 5 years. This is not a turnaround story anymore, because they are a very large, very diversified semiconductor company. AMD trades at 28 to 30 times forward earnings. But pair that with expected growth, and the PEG ratio is a 0.47. And of course, a PEG ratio below a 1 implies undervaluation. Below 0.5 means the market is discounting growth heavily, even though earnings say a completely different story. Their data center revenue grew 60% plus year over year in 2025 and is now AMD's most important profit driver. These are higher margin dollars that matter a heck of a lot more than the old PC heavy model. Reported earnings look a little bit messy because AMD is carrying $3 billion a year in non-cash amortization from Xilinx. That depresses the GAAP earnings, but it doesn't affect cash, where free cash flow hit $2.4 billion, up sharply year over year. I really don't think that income statement has caught up to the business quite yet. AMD right now is moving from chips to rack scale AI systems through 2026. Customers love to buy systems, not just chips, so revenue per deployment rises without needing explosive unit growth. Since 2023, AMD has gone sideways while revenue scaled. Cash flow improved, and the valuation just happened to compress. The stock has never really run ahead of its fundamentals. It's just been waiting. That's the mismatch. You have a PEG at a 0.47, rising data center exposure, improving cash generation, and earnings that are still being dampened from that latest acquisition, which is just accounting noise. Historically, AMD doesn't stay priced like this once the earnings visibility begins to improve. When it comes to AMD, the metric that matters most to me is that PEG ratio. As long as growth holds and the PEG stays this low, the market is betting growth won't last, even though it already is. Analysts are giving advanced micro devices, AMD, 27% upside over the next 12 months. And there you have it. That is my stock picks for 2026 at the very beginning of the year. And I certainly hope that it treats all of us well. As you can tell, some of them spiked quite a bit while I was writing this, but instead of replacing them, I figured I had the conviction to stand behind them before I wrote it. I'm going to keep with it. Now, if you enjoy my content, my approach, along with all of the resources that I provide, then please consider pressing the like button so that my channel can continue to grow. And as always, thank you so much for watching.